Well, we know that most Canadians are sitting on a bevy of equity. It's everywhere, with the average Canadian having at least $300,000 of equity. The question that I get asked almost every single day is, Alex, how can I use this equity to buy an investment property? Now, if you're not on the fence of using your equity to buy an investment property, or you're not interested in using a HELOC for an investment property, well, you might want to watch this video anyways because it's chewy. But if you are, then stay tuned because I'll break down the pros and cons of using a home equity line of credit to fund your next investment project. Let's get right into it, shall we? All right, so let's start off with what the heck is this HELOC thing? I've heard them being called KELOCs and KELOGs and HELOCs and all this kind of different stuff. It's a HELOC, home equity line of credit. So essentially, the key difference between this and a standard line of credit or an unsecured line of credit is that it is in fact secured to your property. Lenders in Canada, at least as of today, allow you to borrow up to 65% of the market value to a maximum of 80% of the market value of your home in the form of a line of credit. That means that at least 15% would have to be a mortgage and 65% would have to be a line of credit if you were to max out your situation. Now, most situations, people might have, say, 40 or 50% equity in their home, and they want to use this home equity line of credit to leverage against another property or other investment. Now, here's the thing. A lot of people, when they set up their existing mortgage, they might not think about the fact that in the future, they might actually want to purchase a property or do something with their equity in their home. So most frequently when I meet people, they don't actually have a HELOC set up in place. So this is something that we'll often see people refinance or restructure their existing mortgage to actually get access to this home equity line of credit. Now, for a line of credit, it is only available with specific lenders and institutions. Gratefully, there are at least 12 to 15 different lenders in the country that are conventional speaking that will actually allow you to do a mortgage plus a line of credit. And they all have pros and cons. Some of them are much more challenging to qualify for, meaning the guidelines are more strict. Some of them are a little bit more loose. Some of them have the ability to break off into multiple components, and some of them offer different rates and terms. No matter which home equity line of credit product that you use, the point is still the same. You can use a home equity line of credit for a down payment on a future property. And in fact, you can essentially 100% finance your second home or investment property if you're qualified to do so. Now let's break down exactly how you can use a home equity line of credit, and then I'll break down the pros and the cons. And I might surprise you with some of the cons because it might not be what you think. Now let's start off really quickly. How do you use a line of credit and what can you use it for? Some of the key strategies to using a home equity line of credit are, number one, and the most obvious one, is a down payment on a new or a second property. Now, the key to remember in this case is to have this home equity line of credit set up before you try to purchase a second home. I know it seems like an obvious statement, but you wouldn't believe how frequently people come to us with a contract on a second property without having their credit line set up, only to have to back out because they didn't have enough time to complete both or they didn't qualify at all. So number one, get qualified and set up the line of credit, but don't do so without a strategy. There are some specific things that you need to know. First and foremost, your mortgage and your line of credit impact the maximum amount that you can borrow on the next property. Whereas even if you want to pay off your existing home in 20 years, we still recommend considering the maximum amortization that you can qualify for in order to keep your payments low. This allows you to qualify for more on the investment or the second property. The second different type of consideration that you should be thinking about when it comes to this type of program is what type of investment you're looking for. Are you looking for a long-term hold, a property that you're moving into? If it's a property you're moving into, then you can use a minimum down payment, which could be as little as 5%, as long as you're qualified to use that through the CMHC financing. You can rent out your existing property, and of course that monthly mortgage and that line of credit will then live on the existing property, where in the new mortgage will live on the property that you're purchasing outright. The second option is to consider purchasing the property as an investment itself. So if you have 20% of the purchase price based on your line of credit or line of credit plus cash, you could purchase an investment property outright using that line of credit. Essentially, you're basically 100% financing that property. Now, the monthly payment is going to live on your primary residence or the one that you are living in right now or wherever you took the line of credit from, but that still is a tax write-off. It is an expense that writes down the amount of income that you earn on that investment property. Now, if you're looking for other investment strategies, lines of credit, you can be using it for a BRR strategy, which is a buy, renovate, refinance, and you can use it for a flip situation as well. You could use it for an emergency fund for a rental property. This is often why we tell people to get a line of credit set up, is actually just as a safety net more than anything else, and so on. All right, let's break down the pros and cons of doing this, and then we'll talk about a few pitfalls that you need to avoid and things to consider if you're using a line of credit. Number one is access to flexible capital. With having a home equity line of credit, one of the nicest things that I like about a home equity line of credit is the fact that you can basically draw that money anytime up to whatever you're qualified for quickly to be able to make a decision on a property. In fact, in some situations, we've seen people who've used their line of credit because they couldn't get access to the capital that they have, their cash that they were going to use for a second home in time. They use the line of credit temporarily as long as they qualify, and it can be paid out anytime. Number two is that you can make interest-only payments. And especially speaking, when rates are lower, this is pretty impactful. You only need to make payments on the interest, which there are quite a few strategies on we'll talk about in a separate video. For the sake of today's conversation, generally speaking, it should mean that your monthly payments are lower. This depends on the rate environment that you're in, but genuinely, it should be a lower monthly payment because you're just paying off interest. The third thing is that it's tax deductible in most situations. Now, whether you're buying a second property or you're investing in something else, generally speaking, a home equity line of credit is interest. That's an expense. An expense is deducting the amount of income that you pay, income taxes that you pay, which basically, again, just means you pay less tax, which is a win. That's another option. The fourth one is it gives you the opportunity to diversify your portfolio using your home equity line of credit to look at different types of investments. And you could also use a home equity line of credit on multiple properties, which brings us to the last point about the benefit of a line of credit, or a last big one, there's multiple others, is the fact that with a home equity line of credit, as your equity grows, assuming you qualify, you can continue to apply for an increase to your line of credit. Now, you're subject to the lending guidelines and rules and changes in the marketplace, but objectively speaking, if your home goes up in value by $200,000 and you qualify for it, you can access that equity in a line of credit and continue to use that for an investment or whatever you see fit in your place. Now, let's talk a little bit about the cons of a line of credit. Number one is it's a variable rate, basically. So you're paying prime plus something. So it could be prime, prime plus one, prime plus a half, prime plus two, whatever that number is. A home equity line of credit is subject to the market. And as we all know, during the years 22 and 2023, well, the Bank of Canada raised rates, which means prime went up 4% over the course of just over a year. And that effectively impacted a lot of people when it came to their monthly budget. So there's a negative to that, but there's also a positive as rates go back down. Number two, the risk of over leveraging. Well, if you put yourself in a position where you borrow 100% of the financing for a property and you haven't properly budgeted yourself or prepared for an emergency fund, the reality is you could put yourself in a position, well, up to at least 80% of a property value where you're over leveraged. You can't afford the monthly payments. And if the property values continue to decline, unfortunately, you'll have to make sure to be able to make those payments back because the lender could call the line of credit or reduce your line of credit at any given time. Now, fortunately, we haven't seen this happen very frequently, but it is a possibility and it's something to be conscious of. So make sure you have a plan or an emergency fund for these situations. The third one is the fact that, well, at the end of the day, your house is on the line. So if you're borrowing money against the equity in your existing property, again, you have to be able to make sure you can service the debt and make the monthly payments. And this might be an obvious statement, but your home is collateral for the loan. Just like a mortgage, if you don't make your payments, even though it's for an investment or whatever else that might be, they can actually foreclose on your home. Again, this is an obvious statement, but something that probably should be said because we definitely want to state the obvious. Now, there's a few things you need to be thinking about as far as like maybe pitfalls or concerns as you go forward, because we don't want to push this as go take out all the money that you can and invest in the marketplace. Number one is like we talked about rising rates. So be fully prepared about the rising rate market. Have a slush fund, have a contingency, make sure you're paying attention to your balances. Number two, you got to watch out for relying too much on property values. And we've seen people get stuck in a corner where every single time their property value went up, they refinanced, but they didn't have a plan for how to get access to the capital. And then when property values declined, well, they couldn't access it and they had leveraged themselves to the point where it was just too much and they had to let go and not have the equity available. So that'll be number two. And really number three is just reducing your flexibility over time. If you do draw all the equity out of your properties, as we mentioned, you need to have a plan to be able to either pay that back or have a strategy to start reducing that monthly payments, because you can simply use so much debt that you're in a position where your expenses are exceeding your income, and obviously there's no benefit to doing so. Basically, have a plan, run your numbers, have a worst case scenario, and then have a backup plan. That's it. Know you're good, know you're bad. So the question that most people are asking is this a good strategy? Should I use a line of credit? Number one, do you qualify? Number two, do you have enough equity? Number 3, have you set up a backup plan or a contingency in place? Number 4, do you want to acquire more real estate? Number 5, have you looked at the options outside of that, such as a mortgage or a variable rate mortgage outside of just the line of credit? And really, at the end of the day, have you thoroughly thought out your plan? I've used a home equity line of credit personally multiple times for both investments in the properties that I own, as well as to purchase properties, the down payment, and it's worked out fabulously for me. But again, I've considered these different facts. If you're wondering if a home equity line of credit is right for you, hit me up in the comments below. Let me know what your thoughts are, what questions you have about this. I'll answer them in a future video. And if you want to find out about working out with my team, of course, make sure to hit us up in the links below. We'll talk to you soon.